Tara Limited is engaged in mining and many other industries and prepare its financial statements following Indian accounting standards and follows April March as their financial year. During the year 2003-2004, the company has faced some issues, and for their solution seeks your professional advice. 1. Tara Limited and Jara Limited partners of a joint operation in the business of mining precious metal. The entity uses a jointly owned drilling plant in its operations during the year ended 31st March 2004. An inspection was conducted by the government authorities in the mining field. The inspection authorities the inspection authorities concluded that adequate safety measures adequate safety measures were not. As consequences, case was and penalty of rupees 100 crores on Tara Limited. On first, the legal counsel the legal counsel of the company has assessed the demand and opined that appeals may not be useful and available to the joint of the joint operations agreement 100 crore to be paid by Tara. 60 crores will be reimbursed by Jara Limited. Tara Limited in 3 months from the any of the demand made in respect of joint operations by any government authorities. However, till the year end, actual reimbursement was not received from Jara Limited. Tara Limited, okay, what is the questions? To joint operations in the business of mining. So, okay, let's read the question first. And however, till the year end, actual reimbursement was not received from the Jara Limited. Tara Limited issued on 1st April 2002 10% interest paid annually and having maturity period of years. Bonds with face value 2 lakh at a discount of 10% to finance a qualifying asset which is ready for intended use at the end of year 2. The company amortizes discount using effective interest effective interest rate EIR method by applying 13.39% per annum of EIR. Tara Limited has invested in debentures whose interest rate is floating in the nature and as per the terms of the installment, interest will be reset every month as per the terms of the rate of interest MEBOR plus 2. It has invested in the debentures to take the advantage of the leverage of interest. On 1st January 2004, Tara Limited installation of the new elevator, a factory of its customer. The entity estimates the following with respect to the contract: particulars, transaction price, expected cost. It purchased the elevator and delivered the same to the site 6 months. Therefore, it is required for installation. The entity uses an input method based on cost to measure progress towards completion. Tara Limited has incurred actual other cost 3 lakh by 31st March 2000. Tara Limited has classified its business in five operating segments, namely A, B, C, D, and E. The profit or loss respective segments for the year ended: segment profit or loss: A 1280, B 2264, C 2280, and D 315, E 2620. Total will be 1319. On the basis of the information, to choose the most appropriate answer question 1 to 5 with the relevant in the AS. With respect of the joint operations engaged in the business of mining precious metal, how will the liability be disclosed in the books of Tara Limited? Friends, that is a question. We are going to solve that question based on the application of NDS 36 and NDS 38. 36 will be impairment. Just to light. Now, we are going to solve this question paper step by step. We do calculations. See, basically, the question is, where is the question? Question is this. Now, our question is, see, with respect, the provision is 100 crores. Why? Reason under Ind AS 37 and Ind AS 111, The legal counsel has clearly assessed that appeals are not useful and the order will be unfavorable. So the payment of 100 crores of the penalty is a probable and the obligation of provision under the Ind AS 37. So Tara Limited must recognize the provision for the full 100 crores, not contingent liability. The fact that Jara Limited will reimburse 60 crores and the joint operations agreement does not reduce the Tara liability. Instead of Tara recognizes a separate asset reimbursement receivable for 60 crores, it recover virtually certainty and a provision of 100 crores for the presently itself. So accordingly, the liability to disclose in Tara Limited books a provision of 100 crores making option B is the most appropriate answer. My dear friends, understand question number one. Answer is the D only. Dear friend, answer is D. How came D? You understood? Come on, explain you. See, this is the point. As per terms of the joint agreement out of 100 crores, see, it is adequate safety measures followed by the entity and joint operations agreement out of 100 crore to be paid by Tara Limited. 60 crores will be reimbursed by Jara Limited. Tara Limited within 3 months from the date of any demand made in the respect of joint operations of any government. However, till the year end actual investment, Tara Limited, next, if you see here, clearly they said during the year ended 31st March 2004, an inspection was conducted by the government authorities mining fields. The inspection authorities concluded that adequate safety measures were not followed by the entity. As a consequence, a case was filed and penalty of 100 crores has been demanded from Tara Limited on 1st September 2003. The legal counsel of the company has assessed the demand and opined that appeals may not be useful and the appeal order will be unfavorable to the joint arrangement. As per the terms of the joint operations agreement under court to be paid by Tara Limited, 60 crores will be reimbursed by Jara Limited to Tara Limited within 3 months from the date any demand made in respect of joint operations by any government authorities. However, till the year end, reimbursement was not received by Jet Limited. And Tara Limited issued on 1st April 2002 10% of interest and paid annually and having maturity period of 4 years bonds, the face value of 2 lakh at a discount rate of 10% to finance a qualifying asset which is ready for intended to use at the end of year 2. The company amortizes discount using effective interest rate EIR method by applying 13.39% of EIR. Tara Limited has invested in debentures whose interest rate is a floating in nature and as per the terms of the instrument, interest will be reset every month. As per terms, rate of interest is before plus 2. It has invested in the debentures to take the advantage of the leverage of interest. On 1st January 2024, Tara Limited took a contract for installation of a new elevator at a factory of its customer. The entity estimates the following with respect to contract transaction price 30 lakh expected cost. Okay. This is the what. So question number one is the answer. Now classify the financial asset and determine the subsequent measurement for the aforesaid debenture instrument. See, for this, What is the answer? What is the answer for this? For this, what I could say, see, financial asset measured at fair value through profit and loss account. Reason is India 109. The debentures paying floating rate of MIBOR plus 2, the monthly Tara Limited has invested to take advantage of leverage of the interest, which indicates the trading speculative actually managed return maximization business model rather than hold to collect the contractual cash flow. For debt instrument to be measured, amortized cost, fair value through other comprehensive income, which recycling both the business model must be hold to collect or hold to collect and sell, and the cash flow must be solo payment or principal and interest SIPs. Here, Here, the stated intent leverage interest suggests that the business model fails the required test. Hence, the instrument classified as a financial asset measure. So, through profit or loss account. So, our answer is C. Answer is C. C. Okay, friends. Our answer is C. Understand, friends? Our answer is C. If you C. Yes. Our answer is C. Correct. Financial asset measured fair value through profit and loss account. Now, let's go to question number 3. Question number 3. Which of the following options will be considered reporting segments for Tara Limited? A, B, D, E, or which one? See, correct option is A, comma B and E. Working as per India's 10A. A given segments rupees A 1280, B 2264, C 280, D 260. Total profit will be 1319. 10% of the profit or less test. Total profit of profitable segment A plus B plus D 1280 plus 2264 plus 315 4219. See the total loss absolute of loss making segment C plus E, that is equal to 280 plus 2620 2900. If you see here, if you see here A profit entity, B profit entity, and D profit entity, whereas C and E are loss making entities. For that, what I did, show Devla, they will take you. Oh, see, working as per Ind AS 108 of reporting segment operations. Here, friends, the given government results, given segment results, A, B, C is the profit making. A, B, C, D, E. Total profit will be 1,390. 10% profit or loss test. Total profit of profitable segment A plus B plus D is the profit for the profitable segments that comes together 4,219 lakhs. The total loss, absolute loss making company C plus A 280 plus 2,620 2,900 lakhs. Greater than 4,290 lakhs, 10% threshold 421.9 lakhs. See, any segment with absolute profit or loss greater than or equal to 421.9 lakhs is a reportable segment A, segment B, segment C. Segment A is reportable, segment B is reportable, segment C is non-reportable, segment D is non-reportable, segment E is reportable. So hence the reporting segments will be A, B, E, which is the correct option is the option B. Next question will go our friends. Next question is come back. Compute the amount of borrowing cost to be capitalized related to qualifying assets. See, for this, what we do? See, we need to compute the borrowing cost. Yes, the correct option is A. How came A? That we will analyze now. 48,753. 48,753. Working according to Ind AS 23 borrowing cost. The 10% of the bonds face value 2 lakh are issued at 10% discount. So initial carrying amount will be 1,80,000. The effective interest EIR rate is 13.39 percentage. The qualifying asset is ready for intended use at the end of year 2. So only the borrowing cost for the year 1 and 2 is capitalized. Using EIR interest, borrowing cost to be capitalized year 1, 1,80,000 into 13.39 percentage. Year 2, 1,84,102 into 13.39 percentage. Why? Already 2 lakh into 10 percentage, that is equal 20,000 is paid. Then extra how much is there? 102. That was added to the cost of the asset. And again into 13.39 percentage. Then 24,651 minus again he paid 20,000. Then so this is the how to calculate. See, dear friend, People's Advocate Sreemannarayana.Mallela, you see here what happened. First, Tara Limited issued 1st April 2002 10% of interest. Let's solve this problem. You will understand better now. See, Tara Limited issued on 1st April 2002 10% interest paid annually and having maturity period 4 years. Bond face value, bond face value, bond face value, bond face value 2 lakhs. Bond face value 2 lakhs. It is issued at a discount. Issued at 10% discount. Then what will happen? 10% means 20,000. Right? Then what will be the value? Value is 1,80,000. Now on 1,80,000, effective EIR rate, yet EIR at the rate of EIR at the rate of 13.39. 13.39 percentage. 1,80,000 into 13.39 percentage. How much? 24,102. Then how much came? 2 lakh 4,102 less interest paid annually. Interest paid. Interest paid. 2 lakh into 10 percentage, that is equal to 20,000. Then the closing figure will be 1,84,102. Again, add EIR at the rate of 13.39 percentage. Now into 13.39 percentage coming 24,000 651. Then 2,08,753. Again less interest paid on face value 2 lakh into, sorry, not a 2 lakh, right? Already out of 2 lakh 20, 2 lakh I paid 20,000. 10% interest only I'm paying. No principal I'm not paying. No. So okay, I hope 2 lakh into 10 percentage. No, again you pay 20,000. 2 lakh 8,750. Then minus 20,000. Then 1 lakh 88,753. See, as of now, if you take year 1 and year 2, the borrowing cost will be for year 1 and year 2. దేవుడా ఎగ్జామ్స్ అయ్యా టైం చాలా పోయింది ఇవాళ దేవుడా మధ్యాహ్నం పోయింది దేవుడా. See, okay, not to worry. The borrowing cost for year 1 plus year 2, 24,102 plus 24,651 comes together 48,000 something. So which option A is the answer? Answer right. Next question.